It's Monday, January 19th, 2026, and I need you to forget the vibe you were fed in the earlier narrative for just a second, because today's price action already shows a subtle but critical difference. The screen is no longer calm. It's starting to price the plumbing problem directly, and the reason it matters is because when silver transitions from a macro trade into a delivery and mobility trade, the market doesn't give you a polite warning, it gives you a gap, a repricing, and a scramble for positioning before the physical bottleneck becomes undeniable as I'm recording this multiple. Widely followed spot feeds are printing silver in the low to mid 1990s. APMEX's live spot box shows 1930 Sangster 4040 Oz, which is meaningfully above the 89 1940 Quiet Sunday level described in the script you pasted earlier, and at the same time, the futures complex is sending an even louder message. Investing.com shows silver futures around 93.1225 with a prior close around 88.537, which is the market saying this isn't just noise in the only language that matters: price, volatility, and urgency, because a near 4 or 5 jump versus the prior close is not what you get when algorithms are lazily doing. The tariffs equal strong dollar, metals down routine. It's what you get when traders and risk managers begin to re-rate the probability of disruption in the mechanism that normally keeps silver priced as one global commodity rather than two semi-separated pools of metal. And this is where we tie today's action back to the big idea in your original narration, the geographic arbitrage trap. The earlier script claimed that the market would look rational, maybe even slightly down, while the real stress hid underneath in spreads and availability. But today the visible market is already moving, which tells us that at least some portion of capital is no longer waiting for dealer premiums or refinery delays to confirm what policy just implied. It's front-running the time constraint. And that time constraint is not theoretical. Major outlets are now repeating the same structure. Tariffs begin at 10% on February 1 and escalate to 25% on June 1 if the Greenland dispute doesn't resolve. So even if you think the politics is theater, the timeline is a hard calendar, and hard calendars create forced decisions and logistics chains, which is exactly why this can become a one-way valve for bullion flow rather than a simple headline-driven spike. Let's break down what today's price is actually doing relative to the narrative. In the original description, the key claim was that tariffs make it economically painful or outright irrational for bullion banks to move silver across the Atlantic in the normal balancing loop, because once metal is shipped out of the US, the cost to bring it back becomes tariff-loaded, which turns what used to be a flexible global pool into a set of semi-trapped regional pools. And the slightly different thing happening today is that the futures market is already behaving as if the probability-weighted world is shifting toward that trapped state, because the move we're seeing isn't a slow grind higher, it's a sharper repricing that suggests market participants are attempting to get ahead of potential margin changes, potential exchange responses, and potential physical premium expansion. In other words, today's price action is consistent with the early stage of the mechanism you described, but it's happening faster and more publicly than the original narration predicted. And to understand why, you need to stop thinking of silver as a single number and start thinking in layers. The spot quote is the headline. Futures are the speculative risk transfer layer, warehouse stocks are the deliverability layer, and the policy tariff regime is the friction layer that determines whether arbitrage can smooth everything into one price. Today, the headline spot price is already higher than the script's calm print, which means the market is not waiting for February 1 to react. And the futures jump tells you the paper layer is trying to anticipate a shift in the deliverability layer, and that deliverability layer is exactly where the story becomes more than vibes. COMEX publishes warehouse stock reports that split silver into eligible and registered categories. And while most retail people look at the total number and say there's plenty, the structure matters because registered is the portion actually available for delivery against. Futures, and Akeem's own silver stock report spreadsheet shows a total registered figure of 120.63 ounces, as captured in the report listing. And here is the psychological trick of a tightening market. That number can look huge until you realize how quickly confidence can change when the shelf meant the tane. Economic cost to replace metal rises. Because if the market believes an ounce leaving a USS vault becomes more expensive to replace under an escalating tariff regime, the incentive becomes do not let it leave unless the premium is worth it. And that's exactly how a system drifts toward a two-tier reality. Even without a literal physical disappearance of metal can exist and still be effectively unavailable at the old price because it has become strategically sticky. And that stickiness is the seed of the trap your original narration described. Akeem Group Silver Stocks report. Meanwhile, on the London side, LBMA's official vault data page reports that at the end of December 2025, there were 27,818 tons of silver in London vaults, up 230% month over month per their own summary. And I'm bringing that up not to say London is empty, but to emphasize the nuance that matters for your story. Vault totals are not the same thing as free float, and they are not the same thing as metal that can be mobilized quickly at scale to meet delivery stress. Even when vault holdings rise, the market can still experience a functional shortage of claims, leasing arrangements, and delivery. Demands collide with newly imposed friction that interrupts the normal balancing mechanism between New York and London. And that's why today's tape matters. Silver is not rising because retail suddenly discovered it again. It's rising because the market is waking up to the possibility that the plumbing may not be allowed to do what it normally does under the new tariff countdown. And when a market senses a constraint, it starts to price the optionality of access. Now, let's connect today's numbers to the math from your original narration, but in a way that stays grounded the earlier script walked through an arbitrage hurdle logic saying that at roughly $90 silver, a 10% tariff is about 90 ISS and a 25% tariff is about 2240.50 ISS. And while I'm not going to pretend we can predict the exact mechanical break-even price that forces flows, the core concept holds. Tariffs don't just raise costs, they alter the willingness of holders to release inventory because every ounce that leaves becomes harder to replace on the same terms. And that's why the slightly different story today is not that silver is quietly drifting, it's that the market appears to be compressing time, trying to reprice months of risk in days, because February 1 is close enough that even a small probability of disruption becomes actionable, and the media framing is now basically irrelevant, because whether you think the Greenland angle is geopolitics, theater, leverage, or distraction, the tariff schedule is being reported as a defined policy threat by mainstream sources, which means this is no longer a niche idea circulating in silver communities, it's now part of the broader risk narrative, and once a risk becomes narratively real, funds and desks have to respect it even if they don't fully believe it, because their mandate is survival first. So how is today's price going relative to your script? It's confirming the pressure point, but in a different sequence. Instead of the spot price staying calm while the physical world quietly tightens, we're seeing spot and futures lift first, which implies either that the physical layer is already whispering tightness loud enough that paper can't ignore it, or B, the paper layer is simply front-running the risk of tightness because policy friction is now the dominant variable, and both lead to the same practical conclusion for your video's thesis. The market is starting to price mobility risk, and here's the key. Mobility risk is not a normal bullish catalyst like inflation data or Fed policy. It's a structural market function catalyst, because arbitrage is what keeps a global commodity from becoming a set of local markets, and tariffs act like a toll gate that can become prohibitive. And when toll gates become prohibitive, the market doesn't clear by politely adjusting a few cents, it clears by creating premiums, spreads, and discontinuities, which is exactly why your original narration emphasized things like FV and paper versus physical decoupling. I'm not going to claim in this script that today we already have a verified FP blowout number in hand, because public dashboards don't always publish that cleanly in the open web the way spot quotes do, but the behavior we can verify spot in the low $90 in futures repricing sharply versus prior close is the kind of early indicator you'd expect before those. Spreads become headline worthy because the first move is positioning, the second move is stress, and the third move is rule changes. And since your original narration also emphasized exchange behavior margin hikes, rule changes, cash settlement risk, today's price action matters because it increases the probability of those defensive responses. Exchanges tend to raise margins when volatility rises, and volatility rises when the market senses a structural constraint. And that's why the battle plan logic in your earlier script remains valid even if today's print is different. In other words, your original story doesn't break because the price is higher than expected. If anything, it strengthens because it suggests the market is not asleep. And if you're going to make this a compelling 2,000-word, one-paragraph video, the way you do it is by narrating the psychological shift. Last night, the story was, nobody knows they're trapped. But today the chart is saying someone knows enough to bid. And that's the moment that turns a niche plumbing narrative into a broader repricing event. You then pivot into the two-pool concept with today's numbers. We have silver at 93.24 on one widely tracked spot feed, futures around 93.1225, and a tariff clock that now has mainstream oxygen. And you frame it as the market pricing not just the metal, but the right to access metal across jurisdictions under friction, then you ground it with the two official inventories that matter to your thesis, the LBA MA vault data showing London's silver held in vaults, 27,880 tons as of end December 2025, and the COMEX registered stock figure, 20/30/16/63 550/75 T7521 ounces per the Keem warehouse report, and you explain in plain language why those numbers don't automatically equal available supply. Because vaulted is not the same as for sale, eligible is not registered, and registered is not willing to leave the country at this tariff regime. And that last part is the heart of your one-way valve, and then you hammer the point that today's repricing is what a market does when it begins to treat future friction as present reality. It shifts the price higher to ration behavior, to discourage casual selling, and to reflect the rising optionality value of having metal in the right place. And the final act of your script is a warning framed as mechanics rather than hype. If tariffs go live at 10% Feb 1, the market will attempt to discover what premium is required to motivate flows. If escalation to 25% remains on the table into June 1, the premium required to compensate for replacement cost risk rises, and the more the market believes the rules won't be softened, the more metal will behave like it's sticky in whichever vault it's sitting in. You close by telling viewers what to watch in the next 48-72 hours to confirm whether today was a one-day repricing or the beginning of a structural phase. Watch whether the futures premium holds. Watch whether volatility triggers margin changes. Watch LBMA communications and vault data releases for any rhetorical shifts, and watch COMEX warehouse reports for the direction of movement between registered and eligible, because when stress rises, big holders often quietly move metal out of deliverable status, which doesn't change the headline total, but changes the market's confidence in delivery, which is what breaks pricing mechanisms. And you end with the core thesis, updated for today's reality. The original narration expected the screen to lie while the physical world tightened, but today the screen is already blinking, meaning the market is starting to listen to the math and the calendar. And whether the Greenland storyline resolves or not, the countdown itself has already begun to express in price. Silver isn't merely being valued, it's being rationed by probability, policy, and the cost of moving it. And that's why today's action spot 93,044 TIA says futures around 93,025 with a much lower prior close matters, as the first visible sign that the tariff valve narrative is no longer just a story you tell after the fact.